Hey there, it's Melissa with Atlas CFO, and today we're covering the 7 mistakes that contractors make on their financial statements and financial reporting. Now, you know by now, and if you haven't, this is a good reminder, that construction accounting is complex. Whenever we think about, we'll call it regular accounting, it has some small inputs. We don't have levels and levels of items to address in every transaction. I just created a quick laundry list of everything that we can address in construction accounting that many times our other industries don't enjoy. The reason why I'm bringing this up first is it's kind of the missing link to understanding why financial reporting can get really tough for construction contractors. And when you understand that we are dealing with a high level of complexity, it makes the rest of it kind of make sense. So let's move on to the top mistakes that we see. So the first one, and actually it's so common, it is not recognizing that there are timing differences. Now, if you followed me for a while, you know I've talked a lot about the timing differences between our billings and our costs coming in. And this one item can just make a mess of financial reporting, and it creates this situation where you have gross profit one month and no gross profit the next, and it creates a wavy line for earnings. So this timing difference is one of the top mistakes that we see on financial statements, and understanding what you need to do to fix it, which starts with a WIP schedule, hint, is a key component to this. The next item that we see people making a mistake with is not recognizing the power of the balance sheet. The balance sheet actually is the powerhouse. It is determining from just one report. People can determine the stability of your company. They can determine even the value of your company. It is so often misunderstood. And when the balance sheet is utilized, reconciled, and reviewed every month, it becomes a powerhouse. Just right alongside our good friend balance sheet and working capital, because working capital is on our balance sheet, and not recognizing how much power this number is in your organization can be a major mistake. You're being judged on your working capital, and so understanding it is of critical importance. Likewise, if you have any of the other 2 mistakes, it will affect your working capital. Oh, labor burden. This is certainly a complex topic because we have to understand what is our true cost of labor. Not only is this important in accounting, but it's actually really more important in estimating. We want to make sure that we have all of our costs covered in our labor burden rate and the labor rate we are using for our estimates. So you can see that this is a critical component, and this is really a good place where accounting and estimating join forces to make sure that they have the right labor burden. Cash flow is super fun in construction, super fun, and to recognize that there are cash flow variances. You can actually see cash flow variances on your financial statements. You get indicators of what is coming for you in cash flow management off of your financial statements. And whenever you remedy all these mistakes that I'm talking about today, you get the benefit of having these indicators built right into your financial statements. So you have to be able to first create that net income in order to get that cash flow. And cash flow is certainly a tough one, and you can see just even from all the things we've already talked about, many times it all shows up in cash flow. Like that's whenever we kind of get hit upside the head that something needs to be addressed. Equity is the section of the balance sheet that just kind of gets ignored. Oh, we don't even know what goes on in that section. Sometimes it's called capital on your balance sheet, and this is a mistake. Equity can tell you so much about the current position of the company and also the future position of the company. So this provides an indicator for the financial stability of the company, the financial strength, and even the company value. We've seen contractors have a request for financial statements and they say, okay, and they just go into their software and hit print and send them. They didn't even look at them. Not checking for whether it was a reasonable financial statement before it is sent is one of the key mistakes that we see contractors make. before you send any financial statement, a balance sheet, an income statement, a work in progress, any financial information, you just stop and make sure that it makes sense. Is what you're looking at make sense and feel right compared to what you already know about your organization? Look for something that's missing. Look for something that's extra. You just want to make sure that you give it a once over before it is sent to someone else. So in summary, if you just think about those 7 mistakes that we've covered, you really can summarize them into some general areas, which is making sure that you have an understanding and a good, accurate balance sheet, understanding that cash flow can sneak up on you either with timing differences or working capital depletion. Know what reasonable job performance is. Know what you are producing from a reasonableness perspective, and also what you should have for that company performance, and even what is reasonable for those labor rates. Now, if you want to learn more, we created a free 7-day boot camp just for construction business owners. And this 7-day boot camp is delivered to you via email. If you want to learn more, we've even got some additional resources in this email stream for you, but it was built so that you could just go through it in 7 days, read the emails, and feel more confident at the end. So if that sounds great, head over to our website and you'll see the 7-day financial boot camp, and you can sign up for it there. As always, thanks for spending time with me, and I hope to see you soon. Bye.